Is free as well.
Good morning. Our session today will be on adjustments. So we're going to look at the 2022 paper, where we're going to look at how to post financial statements from the trial and balance to the income statement to the balance sheet. So before I even talk about the posting, I would want to confirm the duality concepts that are in the trial balance. We use the word pairs. Pairs stands for what? P E A R L S. Pairs. Pairs stands for what? What we debit and what we credit. So if you're going to see the trial balance, it fulfills all this. So purchases always have a debit balance. So even sometimes when you're given to balance up the trial balance, know that purchases always have a debit balance. Expenses always have a debit balance. What expenses are you seeing there? We have insurance, we have office
Office
expenses.
expenses.
What else? We have salaries. What other expenses are you seeing?
Mm,
We have included in the expenses was what? Five
Insurance,
was insurance of 500,
500.
which was relating to the month of April. So meaning this was a prepayment. So we need to
It is very hard.
please mute yourselves as you enter. Included in the expenses was a 500 relating to the month of April 2020. So what is this called? A prepayment. A prepayment, according to the accruals concept, simply states that don't charge what you haven't enjoyed. Okay, so subtract it from uh insurance. You're going to subtract what? 500. Okay, so according to the accruals concept in the adjustment, all prepayment must be what? Subtracted. All accruals must be added. So let me go back to the trial balance. What is a trial balance? A trial balance is a list of all balances. Okay. So as we do this, I need you to understand each of these concepts. So in the trial balance, we use pairs. And the pairs we've talked about as the purchases, the expenses, and the
Assets.
assets all debited. So can we confirm that all the assets have been debited? Yes. So when you go to this, what assets have been debited here? Bank is an asset, right? Cash is an asset. What assets do you have? Fittings and fixtures, those are assets. What other assets do we have? Stock. What type of stock is this? Opening stock. Opening stock is usually in the trial balance and closing stock is even in the adjustment. So this is the debit balance. Account receivable, these are debtors. That is our money. So these are called assets. So to increase the assets, we debit them. Now, assets are usually written in order of liquidity. When you're putting it in the balance sheet, cash is at the bottom. Then what follows cash in terms of being liquid? A bank. What follows bank? This one is already there. You have what? Uh, Prepayment. What follows prepayment? We have debtors. What follows debtors? We have inventory of stock.
Baby,
Okay, these are all called current assets. They're easily converted into cash. These are called current assets. We also have what we call non-current assets. These are fixed assets that are there in the balance sheet. What are the fixed assets that we know? Fittings and fixtures, car, these ones have no order, land, okay, motor vehicle, if there are any. So these are all assets that are supposed to be debited. When we go to the credit side, all revenues or capital, okay, share capital is always credited to increase it. All right, what other capitals do we have? We talked about the 5 types of capital. Who remembers?
Yeah, we have share capital, share premium,
Mhm.
valuation, retained earnings, and the treasury share certificate.
Yes. Mm.
Right. So, share capital. Then we also have liabilities, always have a debit balance, a credit balance. What liabilities do we have? We have accounts payable, it's a liability. All right. We have provision for doubtful debts. These are liabilities. Actual bad debts are expenses, but the provision for bad and doubtful debts. What are provision for the bad and doubtful debts? You provide for as a company to say we may not receive money from these people. So it's a liability you're expecting to lose out. Okay. Why is depreciation on the credit side? Because it reduces assets. So in accounting, the opposite goes on the other side. So purchases returns will reduce purchases. So purchases returns will go on the other side. Sales, to increase sales, we credit. But sales returns will debit them. That's the opposite. So I just wanted you to understand this, the structure of how these come in. So a quick question. Courage outwards, where does it fall? Is the debit or credit? Courage outwards. It's an expense under selling and distribution, so you debit it. How about courage inwards? It's also an expense, except that it's added to the purchases. You debit it. Now there are two discounts, discount received and discount allowed. One is debited, one is credited. Clarify. Which one is debited and which one is credited? Discount received and allowed. So we debit discount allowed because it's an expense, but received, it's a gain on the revenues. So we are going to credit the discount received. So you need to follow pairs, the duality concept. All right. Are we together? So I'm just not yet started. I want to fortify on the things that matter. So let's look at the concepts and how they are applied. So a trial balance is a list of balances. So we have the debit and the credit. So we have revenues and expenses. So to calculate the cost
Hi,
of goods
Colin.
sold, yes.
In a case where we have commission, where does it go? Because I saw a question that has to do with commission somewhere.
Okay. Commission is either payable or receivable. Commission received is a gain. So we talked about gains yesterday. So those are you credited. Okay? Or gains or revenues.
Okay.
Okay. Is that clear?
Okay, it's clear.
Yeah, that's a very good question. Any other question? Okay. All right, so now we want to look at how to answer this question. So our question now has adjustments. See, the first thing is you need to identify the adjustments that you need to make. So we have closing stock. Where does closing stock go? I gave you the format of I gave you
We'll go to the cost of sales and also on the current assets, the other leg.
okay. So I had sent you the format of the income statement as well the format of the I sent you the format of the income statement as well the format of the balance sheet. So let me resend it. So let's discuss the adjustments that are here and how we're going to treat them. So let's start one by one. We have adjustments down there. So how do we treat the first adjustment? Closing stock.
We debit the closing stock account and credit the trading account.
Okay. You heard what he's saying? How do we treat the closing stock? It will appear in the trading account as well as the balance sheet. So you must have behind your head the formats of each of these two. Okay? Behind the back of your head, you need to have the format of each of these two. So we have the format of the income statement and the balance sheet. I sent the format of the income statement. I'm trying to resend it just now. So this will go into our trading account as our closing stock, then it also appear in the balance sheet as current asset. Okay, so that is it. So let's go to the second adjustment. Included is insurance of 500 related to the month of April. Can somebody tell me how are we going to treat this?
So this one will debit the prepayment account and credit the insurance expense.
Okay, so we'll look at the format. I'm sure some of you are totally lost on what we're talking about. Okay, so let me just share the format of the income statement and the format of the financial position. I think this should be at your fingertips, but I shouldn't assume everyone knows. When are you writing this paper?
On Monday.
Not Tuesday, Tuesday.
On Monday.
Monday.
Oh, Monday.
27th.
Oh,
On Monday. Okay, so you literally have how many days?
Little days.
And when are we having management theory in practice?
On Tuesday.
Okay, so you can see the format here. So we have our income statement. We start with the sales, we less returns inwards. What we get is called our sales turnover, our net sales. Then when we go to the cost of sales, we have our opening inventory, we have purchases, we can add carriage inward and less returns outwards or goods drawn. So what we get here are our net purchases. So the net purchases, we add it to our opening inventory. What you get is the total stock available for sale. Then we list our closing stock. What we get is the cost of sales here. And we subtract the cost of sales from our sales turnover. Here is what we get as our gross profit or loss. So the gross profit, you can add other income like discount received, commission received, rent received, as interest received from the bank, or profit from a sale of a good disposal, a decrease in provision. All these ultimately are other incomes from non-related activities of this core business. So we can add that to get our total gross profit altogether on the trading account.
Just a minute. On the columns, which one is the debit? Because there are three. The
This one
first
is
one is the debit.
working. Done many with workings, okay, debit credit. But of course, the duality is not so much followed here, where debit or credit, but the workings are done in here, and these are the key, debit and credit. But just follow this. Sometimes you can put everything in here in the workings, as long as you follow the flow.
Mhm.
Yeah.
Okay.
Okay. Any questions so far? So let's go to now the net profit. So less expenses. Expenses that we have carriage outward, discount allowed, electricity bill, rent, wages and salaries, bad debts, increase in provision. So if there's a decrease in provision, it's an income. Okay. So we also have postage and stationery. These are administrative expenses, advertising, heating, lighting and heating, repairs, all these are expenses. So when you total up the total expenses, we less them from the gross profit. What we get is our net profit or net loss. Okay. So let's go to the format of our balance sheet. A balance sheet should follow this format. Assets is equal to capital plus liability. This should always go through. So our non-current assets, we should calculate them based on the net book value. So we have the costs, the depreciation, and the net book value. So land at costs, of course, it doesn't depreciate, but if there's any depreciation, you put here. Fittings and fixtures. Now, if you notice, the depreciation is in such a way that you put the accumulated depreciation. For instance, these fittings and fixtures, it has a cost of 30,000 and the depreciation is 10,000. So it's supposed to be the net difference, 30,000 minus 10,000, which is 20,000. But if there's any depreciation for this year, you can add it on. For instance, the company says we have 10% depreciation on cost. So meaning this depreciation figure is not complete. So we need to find 10% of 30,000 is 3,000. So 3,000, so we have two depreciations, the 10,000 plus the new depreciation for the year, because each year depreciation assets depreciate. So this is depreciation as far as the year started until today, but it doesn't add the depreciation that we have now. So 10% depreciation on cost, 10% of 30 is 3,000. So what is our total depreciation here? Our total
18.
depreciation will be 13,000. Do you get that?
Yes.
Any questions? All right. So we can continue. So assets. Assets. The current assets that we have closing inventory, trade receivables. So we start with our assets. So we can start with the closing stock, and that is what the figure here. Then trade receivables are debtors. So if you have debtors, it's supposed to be a certain amount, but if there are any provisions or bad debts, you reduce it. For instance, you have debtors you're expecting 10,000, but you made a provision for doubtful debts out of this 10,000, 10% will not pay. So you move 10% of 10,000, which is 1,000, 9,000. Okay, so here we remove any provisions. The net trade receivables. When you put cash at bank, we put it here. And cash at hand, we put it here. Payables, prepayments, so our total assets. So you can see that the order of liquidity. In fact, we start with prepayments. This money can be brought. So we start with prepayments, cash at hand, cash at bank, debtors, and inventory. Right together? Any questions? All right, so we got to our liabilities and capital. So we start with financed by capital. We put it here, add net profits, less drawings. Okay, so we have our capital here. Then you also add the liabilities, the debenture, and the long-term loan. So we have this here. So we have what we call long-term loans, which are called non-current assets, non-current liabilities. A debenture is a long-term liability. A long-term loan also is more than a year. It falls under non-current liabilities. So remember, you need to fulfill the accounting equation. Assets is equal to capital plus liabilities. So our assets are here, the fixed assets. Then any questions? Are we together so far? So
Yes. Now, just a minute. Now that we've identified the elements which are supposed to be in the cash, is it the cash income statement, and also the other financial statement. Now, how do we come up now with the same statements?
so
How
that's
do we
what we want
record
to
them?
do. want to do a question. So before I go to those statements, at least you need to have the format. So
Okay.
it makes sense after I do this and we look at the question.
Okay.
Collins.
Yes, please.
Yeah, maybe you can also highlight how you treat an overdraft account.
An
Where does it
overdraft.
sit?
Okay, that's good. An overdraft is what? A current liability. Okay. So I haven't written the current liabilities yet. So we are yet just on the capital and liabilities. So finance by capital, the net profit or loss, you put it here, you list drawings. Drawings usually will reduce your capital. You know what drawings are? Drawings are simply withdrawals of goods in kind or money for personal use. So we have fixed or non-current liabilities, long-term liabilities there. Then we go to add the current liabilities there. The current liabilities is we have trade payables, which are creditors. Bank overdraft is also part of the current liabilities. Any accrued outstanding bills, you put them there. Any short-term loan, you put it here. Then you have our total current liabilities here. So you total up the current liabilities. So we have what? The long-term loan and the non-current liabilities there. And then you have total capital plus liabilities. So this amount must be the same with the total assets. The total assets, you add the non-current and the current assets. So this is the format that you need to know. Any questions? Where don't you understand? Okay, so can we quickly now go to the question paper? Are we clear with the format? Okay, so I sent you the solution. Is my screen blank?
Yes, it's blank.
Okay. All right, so let's start with this one here. What do we start from?
You had said that you had sent the solution. Was it much earlier before we joined? Because I didn't receive it yesterday.
I'll resend it. I'm trying to look for it just now. Okay, so meanwhile, we need to look at the format of the adjustments here. Let's go through the adjustments. So the closing stock will appear in two books. Okay. Number one, it will appear in the trading account when calculating the cost of sales, right? So we're going to calculate it from there, or less on the expense. So to appear here, in short, and 2 points. Number one, the closing stock will appear here as our closing inventory. It will also appear here as closing event. That is our obvious adjustment. Okay, then next, can somebody explain what happens to the 500 here that is included? what happens to that?
To reduce the insurance expense on the from the income statement on expense side.
Okay,
And
that.
then the other leg will be posted to as a prepayment, prepaid the insurance expense on the current assets.
Okay. So we are going to reduce it according to the accruals concept. We're going to reduce this from the insurance. So this will be 1.5. And after we do that, we are going to add it when we go to the balance sheet. Since this is a prepayment, prepayments appear here in our balance sheet. So it will be a prepayment. All right. That's still our money. So it will appear here under prepayment, non-current assets here. Prepayments appear here. Okay. Then we're done with that. So how do we treat the 10% here?
So the 10% is on costs. So we do 10% of the cost. So we are going to credit the depreciation expense account, and we debit the accumulated depreciation account.
Okay. So, sorry, my screen is blank currently. I'm trying to download the document. I've sent it on the group, the PayDAP group, so you can access the solution and understand what we're talking about. So I've quickly, now that we've talked about the important ways of treating them, so the closing stock, I'll be able to see my screen, is just as it is. Then the insurance, we'll subtract the 500 there. And the fixed, so as in fixed fittings, 10% of 30,000 is what? 3,000. So this 3,000 will total it up to the depreciation. So I have a total of 10 plus 3. You understand this, huh? Then we go to the bad debts written off. We are told that there are bad debts written off of 3,000. So this one's an expense. Okay. Then 18,000 are unrecoverable. So from the accounts receivable of 18,000, we need to adjust this one. So the 3,000 will be subtracted there. Okay, then also we have what? As at 31st March 250 owing in respect for water. This is an accrual. So accruals will add them. Okay, so in the income statement we add accruals. Then provision for doubtful debts increased by 900. So this is an expense when there's an increase. So these are our adjustments. So when we go to our income statement, the rest is just normal. So what we do is our sales figure will be here, opening stock, add purchases. And add purchases, we're going to have to less a closing stock of 8,000. So what we have is our cost of sales. We subtract the cost of sales from our sales figure, we get our gross profit of 26,600. And the expenses we have, insurance was 2,000, we already subtracted the 500, we get the 1,500. Office expenses, bad debts of 3,000, water accrued. Remember, this was an accrual, we'll put it here. Salaries, 25,000, increase in provision. So that's an expense, 900. And depreciation was 10% of the 30,000. This is that one. So these are our total expenses, which we subtract from our gross profit. And we made a net loss of 22,000. Is that clear? Then we go to our fittings and fixtures, our balance sheet. So balance sheet, we have 30,000. So the 10,000 here is we add to the 3,000 that we calculated. So we have 13,000 in total. So the net book value for the fittings and fixtures is 17,000. I hope now it's making sense. Then in terms of liquidity, we have a stock here, then accounts receivable. So on the debtors, the 18,000, we remove the bad debts. On the bad debts, we remove the 900 for the provision increase. And the initial provision was what? 5,000. So provision for the doubtful debts was what? 5,000 there. But there's a 900 we added, which is this one. So this is 5,900. And also the bad debts of 3,000. We subtract all these from our account receivable of 18,000. So this is where the calculation is coming from. So 18,000 minus 3,000 minus 5,000 minus 900. So our new debtors is 9,100. Then we have prepayment of 500, which was paid towards the month of April. Then we have cash at bank, 1, 2, cash at hand, 400. So the total that we have is 19,200. So if you want, you can add this to the total fixed assets to get the total assets. Are we together so far? Did I leave anyone out?
No.
All right.
Collins, how did you treat this 3,000 bad debt? Where is the other leg going?
The other 3,000 was a expense here, bad debts of 3,000. Then again here, the 3,000 appeared here, the 900 and the 5,000. Okay,
And the
so